3 margin hikes, 48 hours, not a gradual tightening over weeks, not a measured response to calm volatility. 3 explosive increases back to back to back while most traders were still processing the first one. And here's what nobody is saying out loud. This wasn't risk management. This was a forced reset. Because when you triple margin requirements in 2 days, you're not protecting the system. You're purging it. Welcome back. I'm going to show you exactly what happened, why the timing matters, who got destroyed, and what this signals about the next 30 days, because this pattern has a name. And once you see it, you can't unsee it. Quick favor, subscribe right now, because when the next margin assault hits, and it will, you'll want the breakdown immediately, not when everyone else is panicking 3 days later. Now let's get factual. Fact. COMEX raised initial margin requirements on silver futures 3 times between specific dates. Fact, the cumulative increase brought margin from roughly $8,000 per contract to over $24,000. Fact, that's a 200% increase in cash collateral required to hold the same position you had on Monday morning. Interpretation, someone wants the leverage longs out, fast. Let me explain what that actually means in human terms. If you were holding 10 silver contracts on leverage, you were posting around $80,000 in margin. After the first hike, that number jumped. You had hours to wire more cash or your broker liquidates you. Before you could even catch your breath, the second hike hit, then the third. By the end of 48 hours, you needed $240,000 in your account to hold the exact same 10 contracts. Same metal, same position. 3 times the collateral, overnight. Now, if you're a billion-dollar fund with a treasury desk and credit lines, that's annoying. You move money, you adjust, you survive. But if you're a retail trader, a small hedge fund, or anyone running tight on margin, you don't survive. You get sold out, period. And when thousands of traders get sold out at the same time, you don't get orderly exits. You get a stampede. Price doesn't drift lower. It cliffs. Stops get triggered. Market orders flood the book, and the sell pressure feeds on itself until the forced sellers are done. That's not a market. That's a liquidation event, and liquidation events don't happen by accident. When silver is threatening to break out, here's the first lesson. Margin hikes are a weapon, not a policy tool. A weapon, and they get deployed when the wrong people are winning. Now let's talk about timing, because timing is the tell. Silver was pushing into the mid-80s. Momentum was accelerating. Open interest was climbing. The leveraged crowd was leaning heavily long. Everyone who ever wanted exposure was getting in. The setup looked explosive, and that's exactly when the hammer dropped. Not during a calm grind, not during low volatility, during the exact moment when a breakout could have triggered a real squeeze. Ask yourself this. If the goal was truly to reduce systemic risk, why wait until the market is ripping? Why not raise margins during the quiet periods when volatility is low and traders can adjust without chaos? The answer is simple. Because calm adjustments don't force exits. Chaos does. Let's get more specific. The first hike hit when New York was winding down for the day. The second hike was announced before Asia even opened. The third came while London was thin. Every single increase was timed to maximize disruption and minimize the ability of traders to respond. That's not coincidence. That's coordination. And coordination means someone decided this had to happen now, no matter the collateral damage. Here's the second lesson. When margin hikes cluster in hours, not weeks, you're watching controlled demolition, not risk management. Now, let's break down the mechanics because most people don't understand how brutal this gets. Margin isn't static. It's recalculated constantly. Your broker checks your account equity against the requirement every session, sometimes every hour. If you're under, you get a margin call. A margin call gives you a window, sometimes a few hours, sometimes less. If you can't meet it, the broker doesn't ask again. They liquidate, they sell your position at market. And in a falling market, market means whatever bid exists in that moment. It means you get destroyed at the worst possible price. Now multiply that by the crowd. When the first hike hit, some traders got calls. They scrambled. Some met the call, some didn't. The ones who didn't got sold out. That selling pushed price lower. Lower price triggered more margin stress for everyone still holding. Then the second hike landed before the dust settled. Another wave of calls, another wave of forced selling. By the time the third hike hit, the market wasn't even trading fundamentals anymore. It was trading survival. Traders were dumping positions not because they thought silver was done, but because they couldn't afford to hold. That's the trap. And it's designed exactly this way. Here's the third lesson. In a margin squeeze, conviction doesn't matter, only collateral matters. Now let's talk about who benefits, because forced liquidation is a transfer event. When weak hands are forced to sell, someone else is buying, and that someone is usually sitting on cash, waiting for exactly this kind of chaos. Large institutions with deep pockets don't panic during margin hikes. They step in. They absorb inventory at distressed prices. They cover short positions that were underwater. They accumulate size that would normally move the market if they tried to buy it cleanly. So ask yourself, If you wanted to acquire a massive silver position without driving price to the moon, what would you do? You'd create a liquidation event. You'd force the leveraged crowd to puke their holdings into your bid. You'd let the exchange do the work for you. That's not a conspiracy theory, that's market structure. And market structure has winners and losers. The losers are always the ones who can't post more cash. Now, here's where this gets darker. Let's look at the historical pattern because this movie has played before. 1980, silver spikes toward $50. Margin requirements get hiked repeatedly in a short window. The rally breaks. The leveraged longs get crushed. The narrative becomes greed and speculation, not supply and demand. 2011, silver surges past $48. Margin hikes hit 5 times in 9 days. Each hike forces more selling. The move reverses violently. Retail gets wiped out. Institutions cover and reload lower. And now, late 2025 into early 2026, silver pushes toward record territory. Margin gets tripled in 48 hours. The pattern is identical. Same playbook, different decade. So when people say the exchange is just managing risk, we should respond with one question. Why does risk always need managing right when silver threatens to run? Here's the fourth lesson. History doesn't repeat, but margin hikes do. And they always hit at the same inflection points. Now let's separate the official explanation from the real explanation. Officially, COMEX will say volatility spiked, so margin had to rise to protect clearing members from default risk. That explanation is technically true. Volatility did spike. Margin does reduce default risk. But here's what they won't say. Raising margin also reduces buying power. It forces position exits. It changes the flow of capital. It shifts the balance of power from leveraged speculators to cash-heavy institutions. And that shift benefits the entities that were on the wrong side of the move. If the market was heavily short by large players, a breakout above $85 would have been catastrophic. Losses would cascade, margin calls would hit the shorts, covering would accelerate the rally. But if you can force the longs to liquidate first, you create a window to cover, a window to reposition, a window to survive. That's the real explanation, and you won't find it in a press release. Now here's what this tells us about market conditions. When margins get hiked this aggressively, it means the system is under stress, real stress, not the kind you fix with a 10% adjustment, the kind that requires a hard reset. And stress comes from one place, imbalance. Too many claims on too little metal, too much leverage on too thin of a market. Too many people demanding delivery in a system built on the assumption that nobody actually wants the thing they're trading. So when COMEX triples margin, they're admitting something without saying it. The system can't handle the crowd leaning this hard in one direction. The system needs breathing room. And the only way to get breathing room is to clear the excess. Let's talk about what happens next because the next phase is predictable. After forced liquidation, the market whipsaws. It bounces hard as shorts cover and bargain hunters step in. Then it dips again as uncertainty lingers. Then it chops. The goal is to exhaust everyone who's left. Exhaustion is the point, because exhausted traders make mistakes. They sell the bounce thinking it's a dead cat. They buy the dip thinking it's over. They flip their bias 3 times in a week and bleed out through bad timing. Meanwhile, the patient money waits. They don't trade the chop, they accumulate the base. And when the next real move begins, they're already positioned while everyone else is still recovering from whiplash. Here's the 5th lesson. Margin hikes create opportunity, but not immediately. The opportunity comes after the chaos settles and weak hands are gone. Now let's address the question everyone is asking. Does this mean the silver rally is dead? No. It means the leveraged rally is dead. There's a difference. A leveraged rally is fragile. It runs on borrowed money and tight stops. When the rules change, it shatters. But an underlying bull market driven by fundamentals doesn't die from a margin hike. It pauses, it resets, it builds a new base, and then it continues. So the question becomes, are the fundamentals still intact? Did a margin hike create more silver supply? No. Did it reduce industrial demand? No. Did it fix the deficit? No. It changed the collateral rules. That's it. If the setup is unchanged, the rally can reassert, but it will look different. It will be less leveraged, more cash-driven, and probably slower, which is exactly what the system wants. Slow doesn't threaten, slow doesn't force delivery, slow is manageable. Now, let's get practical about what you should watch. Watch open interest. If open interest collapses after the margin hikes, it confirms forced liquidation happened. Watch the spread between front month and deferred contracts. If backwardation persists, the physical market is still tight despite the paper chaos. Watch premiums on physical metal. If premiums widen while futures fall, that's the physical market voting with cash. That's the real tell that the paper price is distorted. And watch the behavior of the largest traders. The COT report will show you if commercials covered shorts during the chaos. If they did, they used the margin hikes as cover to exit losing positions. That's the smoking gun. Here's the sixth lesson. The paper chart can lie short term, the physical signals don't. Now I'm going to ask you two uncomfortable questions. Drop your answers in the comments. 1. Do you think COMEX would have tripled margin if silver was dropping instead of rising? 2. If margin hikes happen every time silver threatens a breakout, is the market actually free? Think about those, because your answer tells you whether you're trading a market or playing a rigged game. Now, here's what most people will do wrong. They'll see the pullback and assume the story's over. They'll sell into weakness. They'll swear off silver. They'll call it manipulation and walk away. And that's exactly what the margin hike was designed to accomplish, to break your conviction, to make you doubt the thesis, to make you sell at the exact moment the smart money is buying. Don't be most people. Here's the summary. COMEX raised margins 3 times in 48 hours, tripling the collateral requirement for silver futures. The timing coincided with silver threatening a breakout, not during calm markets. The forced liquidation was mechanical, brutal, and predictable. The beneficiaries were cash-heavy institutions, not leveraged traders, and the pattern matches prior squeeze attempts in 1980 and 2011. If you want the next update, the moment something like this happens again, subscribe now, because margin warfare doesn't announce itself in advance. It strikes when you're most exposed. Last thing, the biggest lie in this market is that the exchange is neutral. The exchange is not neutral. The exchange is a participant, and participants act in their own interest. So when they triple margin in 2 days, they're not protecting you, they're protecting themselves and the entities connected to them. Your job is to understand that and position accordingly. One final signal. If another margin hike hits while silver is still trying to stabilize, the next wave will be faster and uglier than this one. And when that happens, the only defense is cash, patience, and the discipline to buy fear instead of selling it. Now watch the next 72 hours, because the market just showed you its pressure points, and pressure points are where the real game gets played.